Good afternoon and welcome to Heritage Capital Talks. It's a real pleasure to host today's discussion with Nicolas Firzli, Director General of the World Pension Council and Chairman of the World Pensions Forum. Nicolas is recognized globally as one of the leading voices on pensions, long-term investing, and geoeconomics, advising funds, policymakers, and family offices on how to align portfolios with both resilience and growth. Romania is at an important crossroads with Pillar 2. Families, they want clarity. Policymakers want credibility. And markets want stability. And let me make something very clear. Today, we are not talking politics. We are not debating which party is right or wrong, or who made the better choice. Here we are talking about the Romanian families truly deserve that when you reach retirement age, your pension is something you can live on with dignity. Before we dive in, I'd also like to warmly welcome my co-host, Mr. George Motz, who will join me in leading today's conversation. Together, we'll keep our focus practical. What works, what doesn't, and what Romania can adapt to make Pillar 2 a true income system people can trust. Nicolas, welcome, and it's nice to talk to you and see you again. And next time you're going to be with us in Romania.
With pleasure.
Nicolas, before we go into pension, I want to take a step back. What are you seeing globally, geopolitical, inflation, debt, and how do these forces shape long-term retirement system?
Delighted once again to join you guys today. So to make a long story short, I think, personally, I believe that geography and economics come first, right?
Absolutely.
And something happened in February of this year, end of January of this year, to be precise, 9 months ago. So 9 months ago, when President Trump entered the White House for the second time, it was the beginning of a new era in financial economic history. That new era was brewing under the surface for the previous 5, 6, 7, 8 years. But something clearly happened in February of this year. Why? To make a very long story short, because in his first presidency, 8 years ago, Trump's wings were clipped. He wasn't able really to implement his agenda. His own agenda was not very clear inside of his own head, I think. And more importantly, the Republican Party, his own party, was to a large extent hostile to him. So most senators, most congressmen on Capitol Hill 7, 8 years ago were not on the Trump agenda. And so nothing much happened 8 years ago during the first Trump presidency when it comes to finance and economics or trade. But it's a completely different ball game this year. So in the past 9 months, a lot of things happened in the world economy linked to the new era. What is the new era? It's the age of geoeconomics. And here the key word is geography. And another way of calling it is the new great game. It's a great game pitting the Chinese dragon against the American eagle that will define the world economy and financial markets to a large extent for the next 60 or 70 years, right? So it's really a turning point, maybe more important than the 1990, 1991 turning point, because when the Soviet Union collapsed and when Romania became a democracy after the death of Nicolae Ceausescu, already at that moment, communists had lost. And even if communism had lost already in 1990, to a large extent, even in the golden years of Eastern European, Soviet communism, that ideology had very little impact on the world economy. So even in the halcyon days, the golden era of Stalin, Brezhnev, Ceausescu, the world economy was not defined by communism. Now things are different because the world economy is defined by the new great game. Geoeconomics, what China and America are doing to each other and doing to the rest of the world. that is really impacting all economies the world over. And trade, what Trump called, the Liberation Day or trade liberation, blah, 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 the trade war, is only one aspect of it. To make a long story short, it is a technological economic rivalry. So that war is a new Cold War, and it's not being fought using ballistic missiles or bombs or tanks. It's being fought using as a weapon law and finance. So here the key word is weaponization. The Americans and the Chinese, they're both playing that game, transforming capital markets, international law, into weapons, right? And the poor Europeans are caught in the crossfire because policymakers, not business people, but policymakers in Europe are trying desperately to cling to the old way, the world as it was before February of this year. And that's why they're losing in many ways, because they haven't understood, or they don't want to understand, that now it's a new era, a Sino-American era. So that's one thing I want to say. What are the consequences for financial markets? Well, for example, that trade war is having a bigger impact on global supply chains than the COVID crisis. It is reorganizing and redefining international trade and supply chain much more than the COVID lockdown. And Trump is really using it as a weapon. Like I said, there was a big event which happened in Aberdeen, Scotland, on the 29th of July. Europe capitulated. So speaking in the name of Europe, including France and Italy and Romania, what Ursula von der Leyen did, in my opinion, illegally on the 29th of July of this year, she capitulated. She not only agreed to that outrageous 15% tariff, which is disgusting and outrageous, but also she agreed that in the next 4 or 5 years, German and French and Romanian industrial companies will invest billions of dollars every year to build factories in Pennsylvania, Oklahoma, and Illinois, not in France or Italy or Romania. That is disgusting, and I think that's an unresolved question. So in my opinion, what Ursula von der Leyen did 2 months ago was just a short-term fix. That problem will come back to haunt us because, of course, we Europeans should be spending more money building factories in Romania, in France, in Italy. Otherwise, we will not survive that new era, the age of geoeconomics.
Basically, Nicolas, what I wanted to say, sorry to interrupt you, that we don't know exactly what we're heading. We're talking, me and George, last time about we don't know we go right or we go left. The market is going right and left together. No one knows, and still going up. People are buying still gold, and still the financial market is going up. And basically, what matters to us here and our discussion is where do you think what tell us exactly your views about where the sophisticated pension and sovereign investors are doing right now in terms of asset allocation, because we both know and we all know here that pension funds are taking care of the flood of pension of private people, which is very should be very safe.
Yes, indeed. So what we're seeing really in the past 7, 8 months are a symptom of what? Of that change, that we are entering the age of geoeconomics. So gold, for example, why is it rising? And why I think it will keep on rising, to make a long story short, for 2 reasons. The first is that rejigging, that reorientation of the American economy. What is the objective? Trump is not doing it just for the fun of it, right? He has a clear plan. He wants to reindustrialize America. So he's partly funding it by taking money from gullible, European Union politicians who are accepting to pay 15%, but he's also forcing Asian, Indonesian, South Korean, European multinationals, if they want to do business in America, including Canadian, by the way, and Mexican companies, to build factories in America, and is funding it in part by printing money. And so when you do that in part by printing money, and when the import of some of these commodities and products from China and India and Switzerland, the cost of import is rising because you are slapping import duties, of course, inflation will rise mechanically. And so it rise mechanically, and so people are not stupid. They're buying gold as a hedge against inflation, and they are absolutely right to do so. Another reason why I think they're buying gold is about trust. Capitalism is based on trust. I think there was a great American philosopher and economist, Boston. His name was Ralph Waldo Emerson, and he enters. Back then Boston was the richest city in America, and he enters a bank. First Boston, and back then the banks in Boston had marble columns, and the marble was imported from Italy, and all the counters had gold. The cashiers had gilded chairs, etc. And Ralph Waldo Emerson says it's all beautiful, that gold and marble I see in the first Boston bank, but what is the foundation? It's not the value of what I'm seeing here, the physical value, it's trust. There are rich families, rich family offices, rich companies who put their money in that bank because they trust them. The moment that trust is gone, everything will collapse. And I think it's a great remark. So the second reason why people are buying gold, and when I say people, I include central banks, I include sovereign wealth funds, and I include public pension funds. So the biggest asset owners in the world are these three categories: central banks, sovereign wealth funds, big public pension plans. Some of them are in Asia: Singapore, China, Indonesia, Australia, Abu Dhabi, Saudi Arabia. Why are they buying gold? Because they are losing trust, in part, not completely, but
Absolutely.
they're losing trust in part with the European Central Bank and the Federal Reserve Board, because they think that the European Central Bank and the Fed are printing money unduly, excessively, and that they are debasing, which I personally think is immoral and illegal. They are debasing the value of the currency. So to protect themselves, they are buying gold. Another asset class they're buying is tech. A lot of what you call the market success or the market rise of the past 6, 7, 8 months is
Was from the
concentrated
tech.
in two sectors, which are high tech and weapons, defense. And when it comes to defense, it's 60, 70% American company. When it comes to tech, it's 95% American company. And one last comment I want to make for your viewers is today, if we look at the MSCI World Index, America alone represents 55, 60% of the main world global equity index. 60%, right? What does it mean? It means that today, if you look at the NASDAQ, the New York Stock Exchange, it's 25 times bigger than the combined market cap of Frankfurt, Paris, and London.
Together.
We are from the same generation. When we started working in the world of finance 25 years ago, you and I, the combined market cap of Frankfurt, Paris, and London was only 3 times smaller than New York. Now it's more than 20 times smaller. That is crazy. That's unsustainable for Europe. And that would lead to a lot of market distortions. And when you have market distortions, you have market risk.
Nicolas, I want to bring something for George now. George, what Nicolas was saying is they're investing the pension fund, everyone is investing in gold. Let's bring these guys are investing in gold. What are the pension in Romania are doing? Because I need like 2 words. Tell me exactly what they are doing. And then go ahead with Nicolas and find a solution what they should be doing.
So the Romanian pension funds don't invest in gold. Actually, they buy all the government bonds that they can, and the investment portfolio heavily invested in Romanian government bonds. And to follow up on that, Nicola, I would like to ask you, in your view, what makes a difference between a pension system that works and one that fails? Is it investment design? Because we talk about the investment design. Is it governance, communication, or maybe a mix of those three? What do you say? What do you think?
Great question. Difficult question, but great question. And
But it's easy for you, Nicolas, I think.
one small caveat to what I told Charles earlier: they are buying gold amongst other asset classes. So the key word here is not gold, it's diversification. And so that is a magic word, diversification. Not only the way you allocate your assets across very different asset classes, diversification, but also internally at your country level, Romania, for example, the way you design your pension system and your national economy, right? And from that perspective, I want to say that the national economy of Romania is in quite a good shape. And it's partly the heritage of the communist era. So the communists did many bad things, but they did some good things. And one of the good things they did is the economy of Romania may not be very rich or very developed, but is very diversified across sector. And I think that sectoral, the fact that the Romanian national economy doesn't rely on one single sector, but on 5 or 6 different diverse sectors, is very smart. It's very good for the future of the Romanian economy to have a diversified GDP base, which, by the way, is not the case for most European countries. Most European countries or most emerging markets, they only have 1 or 2 sectors. You guys have 5 or 6 sectors, so the economy is balanced. Now back to pension funds, right? And I think you meant mostly, George, Pillar 2, right? Pillar 2 pensions.
Yeah, both Pillar 2 and Pillar 3. Yeah.
Yes, they are probably not diversified enough, and having too many. So there's one asset class, which is government bonds, right? And that single asset class, domestic government bonds, accounts for the bulk of what Romanian pension funds or pension investors have. The other smaller part, correct me if I'm wrong, will be Romanian equity, right? But they are listed. So Romanian listed equity, which is smaller, and even smaller, there's probably Romanian venture capital, private equity, and real estate, right?
Yes, venture capital and private equity, it's almost inexistent.
Zero.
Or 1% or 1.2%, right? And I think clearly pursuing that sort of diversification logic, common sense and financial economics dictate that Romanian pension funds should invest much more in Romanian equity and non-Romanian equity and Romanian private equity and venture capital and real estate, and therefore
yes,
invest less in Romanian government fixed income. And the problem here is, back to what you said earlier, George, is governance and government. Because here the government is also the pension regulator. They are also the asset management regulator. They control the courts, so they're also the judge. And clearly, if you have so much government everywhere, and that's a very, earlier I said that some aspects of the pre-1990 Romanian policy mix were good, but some are bad. And so what is bad is when you have too much government everywhere, because then you cannot have true trust. Back to trust. If you want to have trust in the system, the pension fund should be able to be held at arm's length from the government. So the pension fund should be allowed to say, you know what? We consulted the best trustees and economists in Bucharest and Washington and Beijing, and we thought a lot. We, the Romanian board members, we had internal discussions, and we came to the conclusion that it was not safe for us long term to have more than 35% in Romanian fixed income, blah, 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 because in the long term, it will reduce returns and it's unsafe. But you cannot do that because there's a pension law which tells you that if you invest less than whatever 60% or less than 55% in government bonds, assets you hold are risky. And if they are risky, you know what? You are going to pay a risk penalty. And so if you pay a risk penalty, Solvency II, Basel II, blah, 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 you say, oh my God, if I increase a little bit my allocation to stocks and mid caps and small caps and venture capital, I'm being penalized. Why be penalized? Let me have a quiet life, no problem. I'll be a good bureaucrat. I'll allocate 65, 70% to government bonds. So really the law should be changed. And when the law changes, one thing should be clear that, that trustee freedom. So why are trustees free? Why are they autonomous, right? Autonomia in Greek mean your own law. Why should they be autonomous? Because otherwise, it's all a fiction. Otherwise, you're telling pensioners and savers that they have a nice, pension system, when in reality, they don't have a nice and solid pension system because behind it, it's 60, 70% government bond from one single country. So risk-wise, in the world we live in, it's too high a risk. So here, the change should be progressive, of course, because if the change is a shock to the system, you will have what Milei is doing in Argentina, which I think is stupid, because what Milei is doing in Argentina is too capitalist, too quote unquote supposedly free market, blah 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 shock. I don't believe in that either. I think there's a middle way. There's a middle of the road centrist solution, which would be progressively, year after year, to reduce by 5, 6, 7% per year in the next 5 years until you guys reach a new equilibrium without being penalized by the pension regulator for buying too many stocks or too many Romanian venture capital or private equity funds.
Actually, Nicolas, things are going to get a lot worse in Romania, because at the present time we have in the parliament there's a discussion about the new payment law, and actually it's a law regarding the payment funds, and they actually are allowed to invest only in bank deposits, T-bills, government bonds, and supranational bonds like the World Bank. So we're still maturing. We're still actually, it looks like we're going the wrong way. In this regard. But if you were advising our Romanian policymakers here, what are the 2 or 3 practices from other countries that could have the most impact?
So correct me if I'm wrong, but I think now in Romania, most of these Pillar 2 pension platforms are controlled by banks and insurance companies, correct?
Correct.
Absolutely.
And some of them are domestic, national Romanian banks and insurance companies, and some of them are subsidiaries of Dutch or French or American banks, right?
Yes.
So from that perspective, Romania is fairly similar to Poland, for example. And I think so when there was a pension reform, in Poland and Romania after the fall of the Soviet Union, I think the same American or British or European consultants.
Yeah, it's the same. It's the World Bank model. Yeah.
So the same American consultants, they went to Bucharest and Warsaw, and they did like a copy paste of their recommendation, blah blah. So what I'm coming at,
It's true.
It's not bad. If it's not broken, don't fix it. So it's not bad. It should be allowed to grow and thrive and flourish, right? But on top of that, there should be some internal thinking at Romanian policy and industry level. So the CEOs of the big Romanian companies and the government across party line, because this is really in the national interest. So it's not something which is liberal or progressive or Marxist or capitalist. It's in the national interest of the Romanian nation. So it's something where employees and employers have a common interest or should have a common interest. And what I'm coming at is keep the existing, Pillar 2 pensions, which are subsidiaries of insurance companies and banks, but add something more. Add perhaps the beginning of sectoral pensions. Once again, it will take 10, 15, 20 years, but you have to start somewhere. And so what I'm thinking of is that Romanian CEOs at sectoral level, they should start thinking of how can they do one pension platform for plumbers, another pension platform for the agro industry and farmers, another pension platform for the hotels and services industry. And you always start small. So you start small because you start from scratch. Zero is the beginning. But year after year, as the companies in these sectors and the employees of the companies working in the sectors put a little bit of their money into these new sectoral industry sector funds, year after year it will grow. So I don't think it's going to eat away what the existing Pillar 2 pension company are doing. It's a complement, and it needs to grow naturally. And once again, I think it's a national interest. Why is it a national interest? Because it's a question of sovereignty. Because if most of the companies owned, if the market cap, look today, look at France and Germany today, because they don't have a strong pension system. Who controls the capital of Mercedes-Benz, BMW, Airbus, Renault? It's foreign pension funds and sovereign funds. So it's the pension funds and sovereign funds of Australia, Holland, Canada. They own most of the shares of the biggest German and French and Italian listed companies because their local domestic pension funds are small. So if you are a Romanian patriot, if you love your country, it doesn't matter if you're from the left or the right, it's your interest to grow the pension pot because over time, more and more domestic Romanian pension or family office investors, they will own the shares of the Romanian companies. They will own prime real estate in downtown Bucharest. They will own bonds, but not only bonds, because if they own too many bonds, it's a problem for the pension system. So I think that logic of growing the pension pot, bringing, very important, the trade unions, the trade unions, the government, the political party, and the CEOs of the big industrial companies, they should work hand in hand. If they don't, it will be a disaster. So first,
Nicolas, because you're answering 2, 3 questions back to back, and I want to ask you about what you said now. So basically, the pension fund should be the engine of the economy. Should be investing in the companies, local companies at least, to grow the economy as well, supporting the local economies. And here, what you said, hand to hand, I think the owners of the companies here, and listed and unlisted, should go and ask for the pension. And this, for Pillar 2 here in Romania, that instead of giving loans to the government and putting the money as the state bonds when everything is going there, and it's not going through to the economy by supporting the local companies. So basically, Nicolas, if you see these two things in a country, Romania or other country, you are funding all the 70% of the pension is funding the state bonds, where basically Romania is in a huge budget deficit. It's they are giving 7-8% in terms of interest, which could be considered as equity, and it's not supporting the local economy.
And it's less than inflation.
Less than inflation, of course. The inflation is double digit. So what are the risks? When you see something like this, give me the risk very transparent, objective.
It has to be bipartisan. Why bipartisan? Because, for example, if you're a statist or left-wing politician, maybe you think that, deficit spending and 8%, interest rate is not the problem, right? It is a problem because it's not sustainable in the long term. And at the same time, if you are the CEO of a big Romanian company from the private sector, maybe you think that putting more money every month in the pension pot of your employees is like a payroll tax, and you as a capitalist don't want to put every month, another 4% or 5% on top of the salary and payroll tax in the pension pot of your employees because you think the government will take care of that. In both cases, both the right-wing sort of capitalist CEO and the left-wing government spending philosophy, it's bad. In both cases, they're hurting the interest of Romania long-term. The interest of Romania long-term is to invest more in the national economy, to reorient more domestic capital to GDP growth in that global, economy we live in today, which is very competitive. We have China and America really conquering the world, right? So how can you defend Romania's interest? And to answer your question, Charles, it is not sustainable for governments to spend that much money and to rely on debt. So that's the short answer.
Absolutely.
It doesn't mean there'll be a crisis tomorrow morning or Monday morning. It means that progressively government must cut spending and try to get their house in order, because in Romania, inflation is a little too high, and the interest rate which government borrowers pay to international lenders and domestic, to international buyers of their debt and to domestic buyers of their debt is too high. 8% is really too high. It is not sustainable in the long term.
Absolutely.
Yeah, and building on that, I want to talk about the members and going from the government to get to the people, to those who actually benefit from those pension. I want to talk about the member trust and the communication issues here. The truth is that many people don't read long reports. And the Financial Supervisory Authority has a lot of data. It has reports that go tens or hundreds of pages. The pension fund management companies, there's mandatory for them to publish reports as well, tens of pages long. I don't think anybody just sits, except me perhaps, but I don't think anybody sits and reads these long reports. What's the simplest way to show a member at age, for example, 55, what their savings really mean for monthly income?
Okay, another interesting question from George. So if you had asked me the question 15, 20 years ago, my reply would have been long and circumvoluted, and I would have told you that it's very bureaucratic and complicated. But the world changed in the past 2-3 years for two reasons. The maturing of digital-based admin processes, but more importantly, AI. AI will not revolutionize everything, but here it's something which is fairly easily automated if programmed smartly. So combining digital access and AI, today it's much cheaper to offer these services than 10, 15 years ago. And it's maybe 10 times cheaper, and it's more efficient and faster. So even if your average, 55-year-old Romanian Joe who works as a plumber or engineer in Timișoara, whatever, maybe he has one pension pot in the second pillar, and is also a beneficiary or future beneficiary of the first pillar. And maybe he also has a small apartment which he's renting as a complementary source of income with a monthly rent for his old days. So all that together, he can have in a computer. And in a few seconds, the computer can tell him what is his position now. So maybe now he's working, maybe in 5 years he would retire. So the computer will tell him that is your position now, and in 5 years, the day you retire at age 60, you will start earning X per month, and a quarter of X will come from the government social security first pillar, 40% will come from your pillar 2 pension funds. Maybe one of them will be the ING or SocGen pension fund, and the other one the National Plumbers Association pension fund. And the fourth source of income may be that studio flat he's renting to a student and is giving him an extra 20-30% boost, blah blah blah. So all that can be easily done today, and all the big consultants, all the Towers Watsons, Mercers, Deloitte of this world, they can do it now. And there are tech companies, they're American for the most part, big tech companies like SS&C Technologies, who also have that tech backbone to do that, combining
Yes.
advanced IT, AI, etc. So to make a long story short, that today is less complicated and it's easier. And to go back to what George said earlier, it gives you power as a future retiree. Because understanding the situation is the beginning of power. So I think it empowers savers and pensioners.
Nicolas, so basically now everyone can know exactly how much they can have income or whatever just using the AI, which is a very good tool for members to see exactly what's happening with their pension. Nicolas and George, before I close, I want from you, Nicolas, first, based on your experience working with pensions worldwide, Europe, Asia, US, can you just give us like one piece of advice, like 2 lines from you, a piece of advice for policymakers first / members for their pension, here in Romania?
What I would say is trust your own people, allow them to invest more early on, because the earlier you start, the better. Why are today the Australian, Canadian, Dutch, Danish, Swiss pension funds so big, so rich? Because it took them 30-40 years of investment, right? So the more, as a policymaker, the
Yes.
more you delay pension reform, the poorer your country will be. The earlier you start pension reform, the earlier you allow people to save via Pillar 2, Pillar 3, but also family offices, but also savings accounts, etc. If you allow people to save early, if you incentivize people, if you lower the taxes on savings, on capital gains, if you lower the taxes on capital gains for assets invested domestically in Romania, your country will flourish and prosper.
Perfect. George, can you give us like 2 words, advice for policymaker here and for members, for Piranudoi?
Actually, I'll give you in just one word.
One word.
One word,
Tell us.
and that word is awareness. And I want to elaborate on that. Awareness from the policymakers, awareness of their members of the citizen needs in regard to what expectation they have for the retirement when they will retire, and the same awareness for the members,
Yeah.
which actually don't show much interest for the second pillar, and they actually, most of them are randomly allotted, and they do not choose a pension fund, because in Romania participation is mandatory to the second pillar. So I think both of worlds, both policymakers and us, the members, should be more aware of the private pension system and should work closer and together to ensure that we have an adequate future in retirement income.
The pension funds, basically, we should all know that the pension fund could be the engine of the society and the engine of Romania going forward. Nicolas, thank you for sharing your global perspective with us.
My
What you've
pleasure.
heard today is very clear. Income first. Excuse me, Nicolas.
Yeah, my pleasure. And I wanted to say, before I leave you, that of course we would be delighted to count you amongst us at the European Pension Forum in London on the 20th and 21st of November, where we also have some very large family offices from across Europe. So we'd be delighted to welcome you and host you then. And some of the leading pension policymakers from Sydney, Melbourne, and Washington, D.C., and Brussels will be with us 20th and 21st of November. And we'd love to have you as panelists, rapporteurs, or speakers on Romania.
Anytime you want. Thank you so much for the invitation, Nicolas, and hopefully we see you as well in November in Romania.
With pleasure, with great pleasure.
Nicolas, thank you for sharing your global perspective with us. What we've heard today is very clear. Income first. Pension must deliver monthly income people can live on. Trust through governance. Boards, managers, and policymakers must earn trust through transparency and discipline. Global best practice adapted locally. We don't need to reinvent the wheel. We need to translate what works to Romania's reality. And again, this is not about politics and who is right or wrong. It's about making sure that after decades of work, Romanian families can retire with dignity and stability. If we do this, Pillar 2 becomes not just a saving vehicle, but a true retirement system that protects dignity, supports families, and channels long-term capital into the economy. Thank you for joining us, and special thanks to Nicolas and to my co-host George for guiding us through today's discussion. And for sure, George, everyone should be able to know exactly what they are doing. Pension, policymaker, and the people. Thank you so much, George, for joining us.
Thank you for having.